We should be live. Testing, testing, one, two, three. Takes a second for YouTube to fire up. And I think you got a spring on your mic stand that's really causing a big vibration and a doom.
Oh,
So if you watch your thumping on the desk.
okay. I won't bounce my leg.
There you
First
go.
time.
There we are live now. Jacob, happy new year, my friend. First time streaming with you so far, but we chat every hour, every day. How was the slide into 2026?
Good. Yeah, I had a nice. You spent a lot of time with family. I feel like holidays last forever. Like after Thanksgiving, and then everyone gets together, and then Christmas, and then New Year's. I'm happy to be back to regular. Good time with family, but glad to be back to a good schedule.
But if you work every day, time flies. So that's kind of my strategy.
It's true. It was a fast year. Fast 2025.
Yeah, I didn't even notice. I didn't even know what day it was, whether it was Christmas Day or New Year's Eve or whatever. It doesn't matter to me. But let's get into covered calls. And the reason for this, as you know very well, Jacob, covered calls made me in the 90s. I used to call it my personal money printer. And that's your little image here. So when I sent you that graphic the other day, you picked up on it. Like literally, you can own a bag and you can make a huge amount of money from your bag by which to live while retaining your bag, and it appreciates. By the way, hopefully the retire on model will be out tomorrow. K8, let me know if the dev team have any update on that. They did promise me January 6th. So that'll be a huge part as well of determining what you need to live, when you can retire, how much can you spend during retirement, and how much you can retire from. That's basically the mission of that product, and that's coming out too. But if you need to turbocharge your wealth, easiest way is covered calls. Boom, take it away. And let's make it as interactive as possible. With maybe I'm going to mute.
Yeah, if you guys have questions during, like, I think Kay or James, you can highlight them. Like, I'll be watching the chat. So if you have questions during, like, please just jump in. We can pause and take questions whenever. So yeah, covered calls. I know a lot of people have been asking for this. Every time James posts a trade alerts, I try to make a video about it. And we've had a lot of great examples recently for covered calls with A-Lab and Tesla. And so we're going to go over those examples and how everyone can get started. Okay, so here's our agenda for today. If I can keep going. So we're going to talk about, I'm going, and this angle is, I'm going to try my best to go from, if you know, zero, and we'll quickly ramp into covered calls. So absolute basics of calls. Then we're going to talk about the difference between long and short calls. We'll talk about covered calls. We'll jump into the charts after that and look at some of the settings. Mean reversion is key here. Okay, and then I actually have a portion, because a lot of people don't even know how to place a trade. And I know a lot of people are on Fidelity. I personally don't like Fidelity, but I wanted to show how you can do that on Fidelity. Mean reversion, a little bit more about mean reversion, back testing as well. And then we'll go through some examples and then position risk management. Okay, so a lot to go through today, but I think you guys will find this interesting and useful. Okay, so let's keep rolling here. So a little bit of terminology before we get started here. Intrinsic value versus extrinsic value. You're going to hear this a lot when it comes to options, and you just have to remember that if their extrinsic value is your time value, okay, and intrinsic value is the actual profit if you were to exercise your call option right now. Very, very basic example. If we were to go look at the Tesla chart, okay, Tesla is currently trading at 455. Let's call it, okay, 455. Let's say that you had a $400 call, and the value of that call, let's call it 80. Let's just say it's 80. If we're trading at 455, you have $55 of intrinsic value. Okay. Well, your call's worth 80, right? Because there's potential, there's probably still time left, and there's potential that it's going to keep going up. Okay. So your extrinsic value is the extra. Okay. It's the volatility, it's the time. Okay. So you would have $25 of extrinsic value on that call option. Okay, so that's the difference between intrinsic and extrinsic. When we sell calls, we are typically almost always selling 100% extrinsic value, time value. Okay. And we'll get more into this as we keep going. Okay. So that's intrinsic versus extrinsic. Some other basics here. Your strike price is the predetermined price.
I'd like to add
go
something very important before you get into covered calls. A big part of what I like to do as well is buy leaps. You know, you sell short-term stuff, you buy long-term stuff. Easy way to think about it. But if you are buying leaps standalone, try always buy some intrinsic value. Never, ever buy all-time value, unless, of course, you see something like Tesla falling to $106 and you know it's going to mean revert, and you want to buy as many calls as you can. Then you buy a truckload of $140 calls out of the money. That's the only exception. So that's very important to wrap your head about. Think about, you sell time, you buy intrinsic value. Always remember that, everybody. Sell time, buy intrinsic value. And in investing and trading, all the money is in the selling. You don't make diddly squat until you start selling something. So my 2 cents.
Thank you. Yeah, whether it's selling options or selling shares, right? You don't make any money until you sell. Now, we don't really always want to sell shares. So that's why we can sell options instead. Okay, so we'll talk about that. A few key terms here. Then we're going to go into buying options, what James mentioned, buying leaps. Okay, so your strike price is the predetermined price at which you can do something, right? So if in this picture, right, the 192.50 call is saying that this person can buy shares at the predetermined price at 192.50. Okay, you always have an expiration date. So that's fairly simple. And the premium, okay, the premium is what you are paying for the call option, or if you're selling, it's what you are receiving for the call option. Okay, so some basic terminology there. Now, call options. We talk a lot about leaps here in this community. Okay, a call option gives you the right, okay, the right to purchase shares at a predetermined price. It's almost like a placeholder, like a rain check, right? Like if you buy the 300, right? James bought a ton of $300 calls on Tesla. What does that mean? Well, no matter what the price goes to, assuming it's above 300, right? If you have the $300 call, if it goes to 2,000, which we all hope it does, then you can still buy shares at 300, right? So this would have an intrinsic value of $1,700, right? And the reason why we would want to do this is there's a lot of leverage in this, right? You pay a smaller amount to control 100 shares, and then in hopes of price going up. Okay. Now, nobody gives you this contract for free. Okay. You must pay a premium up front. So maybe the $300 call costs you $100 debit per share, let's say. And remember that everything is times 100. So if it's $100, it'd be $10,000 for this contract. Okay. If you buy a $300 call and you paid 100 for it, you need price to be at least above 400, at least above 400. Okay. Because if we go up, let's say we only go to 350. This only has an intrinsic value of $50. Well, you paid 100 and you made 50, right? So that wasn't great. That's not a winner there. Okay, so you need this to go up quite a bit. All right. So this is a buying a call option, is that you have the right to purchase 100 shares at the predetermined price or at your strike price. Okay. So let's keep rolling here. Now, there is this, as we know, and as James always says, this is a zero-sum game. There's always for every winner, there's a loser. Okay. And so, so let's talk about this. And key takeaway here, before entering any trade, ask yourself, why would someone take the opposite side of this trade? This perspective helps you identify risk and opportunities you might otherwise miss. Okay. So one more example here. Actually, let's go one more slide. Selling calls is the other side. Okay. So let's go to my whiteboard here that I like to use. There is always a buyer and there's always a seller. There's always two people, buy, sell. Let's say that there is a contract, right? We used our $300 call. Here's our $300 strike. If you're buying this leap, right, you are paying the seller the premium. Let's call it $100. And in return, the seller is giving you this contract. They're the ones that are signing up to give you those shares, right? So let's just pretend price actually does go to 2000 one day, okay? And you're like, great, I'm going to exercise my contract, right? And I'm going to buy these shares for 300, even though price is 2000. Well, who is giving you those shares? And it's the seller, right? It's the seller that has signed up to deliver those shares to you. Okay, so there's always a zero sum game. So if we look at like some of the risk here, right? If and let's type this down here. Your break. So if you paid $300 for your call and you paid $100 for it, your break even on this trade is 400. Your risk, again as the buyer, is 100. It's what you paid. Your max profit is infinite. Okay, this is the profile of the buyer. Well, this equation needs to be balanced. If you can win infinitely, that means someone can lose infinitely, right? On the other side, because they have to deliver those shares to you. So if we think about this from the perspective of the buyer, or of the seller, okay? If price goes to 2000, what do you need to do as the seller? Well, you need to go out to the marketplace, right? The marketplace, whatever. And you need to buy shares for 2000, and you got to turn around and sell them to this guy for 300. So you lost 1700. Right? So this equation is always balanced. If you win, someone else is losing. If you lose, someone else is winning. Always, 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 always. Okay. And this is why, right? This is a good example, by the way, of why we don't sell leaps, right? We don't sell 2 years out because we don't know where price is going to go. Like we don't even know where price is going to go 30 days from now, let alone 600 days from now. Okay. And so when we're selling options, when we're acting as the provider here, we want to sell short time. Okay. All right. So that's a quick overview of buying versus selling calls. Now, a few notes here. Selling calls is directional. Okay. It's price, right? You don't want price to go up. So you either want it to be neutral or go down slightly. Now, it is a limited hedge. It's okay at hedging. It's not perfect, but it's okay, right? So, for example, if we were to jump into the charts here and we go look at this major drawdown, right? Like we went up to 480, all the way back down to 220. Let's say that you sold calls up here, and let's say you brought in $30 on the calls that you sold. I mean, we went down $250 from there. And so yes, you brought in some money and you hedge yourself a little bit. But right, if we have a huge drawdown, then selling calls is not a great hedge, but it brings in something. Okay. So just keep that in mind as well.
And as one other thing I want to mention there too is that was a very unusual circumstance because of Doge and the retaliation against Elon Musk. But even though it may seem like you sell a covered call for $25 against like a $500 stock, if you're doing that every 6 weeks, it really adds up a lot. That frequency really supercharges your bags. So focus on, again, not waiting for, some people make the mistake of, I'm going to sell a covered call every 30 days. No, you wait for the chart to tell you. And we'll show you exactly how to do that in a while as well. But just those big fat pitches that come along, and I use the term from Warren Buffett, may he retire in peace, but he waits for those key moments. And that's what, again, one of the biggest virtues in investing is patience. Have a sticky on your bathroom window. Patience. Wait, because then your ROIs is so much better when you're so much more patient. Don't think you have got to sell covered calls on a regular time basis. You sell when the market tells you to do. That's the same thing. Same thing for a dip in price. That's when you sell a put. Spike in price, you sell a call. That's all you need to know. It's not hard.
Yep. Yeah, and I forgot to mention that. A lot of people ask me like, well, I want a covered call strategy that I can do every 30 days, no matter what, because I'm trying to replace my income or whatever. And I think that's, and then people have shown me like spreadsheets before of like, well, Tesla never moves more than X percent a day or whatever. And that I just completely disagree with that. So, like James said, look at the chart. You have to use mean reversion, right? And we don't just sell every 30 days no matter what with our eyes closed. Like, you have to wait for the prime opportunities. Okay.
And by the way, another quick question here. Yes, it's not a if you have a stock that's going to fall 50%, a covered call will not save you. It'll alleviate the damage, but it's not going to save you. If you think something really bad is going to happen, odds are the whole market knows that as well. And odds are things like insurance, which would be a put to buy, will be very expensive.
Yeah.
But if you do feel that something is going to come that could be really ugly or really nasty, then instead of selling a covered call, you could actually sell a covered call and you could buy a put as well if you want to protect yourself. And you could buy that put out of the money too. So imagine you got $100 stock. This is probably getting a little too deep here, but for the advanced traders, they'll get this. Imagine $100 stock. You sell a call for $20. That'll take you down to 80. But then if you think something really shit is going to happen over the next 12 weeks, you buy the put with an $80 strike or below. And that way you insure yourself down below that too. Yeah. If you have that information.
Yeah, like if you had so we'll go back to this Tesla here. Let's just say you had a crystal ball and you knew this was the exact top. Would you sell a call or would you buy a put? And the answer should be both, but let's just say you should buy a put to hedge yourself. And the reason for that is when you sell, okay, you sell a put or you sell a call, the most you can make is the premium you received. That's it. Like you think about car insurance company. How do they make their money? From you paying them a premium every month, right? That's how they make their money. And so it's the same thing. When you sell a call or you sell a put, you are capped on how much you can make and you're capped to the premium. So in this case, right, again, if you sold a call for 30 and we dropped 200, then you only made 30, right? But if you buy a put, then you make as much as the put goes down, right? As much as price goes down. Okay. So that's why covered calls are neutral strategies to slightly bearish. If we're like super mega bearish, then you should be buying puts. Sell a call, buy a put, whatever. Okay. All right. I think we lost our slides here, James. Okay, perfect. Thank you. All right. Great question. And Options Goddess, yeah, shout out Options Goddess, by the way. Laura, great options trader, callers, right? So look, if you want to learn more about how to protect your portfolio, callers, she also has a great class. And I also shout out Josh, by the way. Josh trades. He also trades for a living and he sells calls all day long. So Josh is a great options trader as well. Okay. All right. So I wanted to go through an example of just very, very basic example of how you would do this in practice. Okay, so I brought up this was my wife's old retirement account when she was working. All you have to do, so you have to make sure you have options permissions. Okay, that's number one. Number two, the way that I would do this is for under Fidelity, there's a news and research tab. You're gonna go to options here, and now you have your options chain. Once you're on your options chain, okay, we can type in Tesla or whatever you're gonna sell it on. And this brings up the options chain. Now, I know the options chain looks kind of scary when you first look at it because there's all these things going on. This is always true. This is pretty much always true no matter what options chain you look at. Calls on the left, puts on the right, strikes down the middle. Okay. What we care about is open interest and delta. Okay, that's really the only things we care about. And of course the price. But if I scroll down and we can pick our different dates that we want to pick from. Okay. And so this expires in 4 days. So our typical threshold is 30. When we get these big mean reversion spikes, we're looking for 30 to 45 days. Okay. So maybe I would pick, we're going into some nuances here with Tesla, but if all things aside, here's our 32-day expiration. Maybe we would want to go out to February 20th to have a regular instead of a weekly. There's going to be more open interest on the regulars. Now, we can scroll down here. And again, this is just very basic. All I'd have to do is if I click on let's say I want to sell a $500 call on Tesla. This is a 33 delta, and I'm going to get $15. Okay, let me highlight this so everyone can see. Sorry, right here, this box here. Okay, $500 call. I'm gonna get about $16 for it. Okay, plenty of open interest. I look at the 13,000 contracts. Okay, you want to make sure that there's plenty of open interest. You don't want to be trading by yourself. Okay, and the delta is 33. Typically, we would say 20 to 30 delta when we're picking this. So this might be a little bit aggressive. Now, when we do this, what are we saying? We're saying I don't think price is going to go above 500 plus the premium we received. Okay, so 500 plus I'm covered. Remember, I'm covered for $15 more up to 515. So I don't think price is going to go above 515. Okay. And how would we know that? Well, we'll get there in a second, but with mean reversion. Okay. So this is the very, very basics of doing this on Fidelity. I would hit sell here. Okay. This would bring up your order window. And this is really important here. Pick your account. Okay. Your action here is sell to open. You are opening a new position. I know people get confused with this, but you are selling to open a position. Okay. So sell to open. One contract controls 100 shares. Sell on a call, pick your expiration, pick your strike, and here's your limit price. Okay. Now remember, let's look at this. Make sure this looks right. Does this look right? And I'll say yes. Your max gain, the most you can make, is the credit received. The most you can lose is infinite. Okay. And your break even is at 515. Okay. Now, if our max loss is infinite, this is why we don't do naked calls. Okay. This is why we always do covered calls. So let's look at the math behind and what does it mean to be covered? Well, if you own the shares, if you own 100 shares, that is a covered call. Okay, you're selling a call against your shares. Okay, let's go back to our example here. If I decide to sell a $500 call and I got $15 credit for this, right? Remember, I'm short here, -1. I'm short a call. If price goes up, let's say it goes up to 550, hypothetically, right? What is this contract now worth? This contract is now worth 50. Okay, 500 to 550. This has an intrinsic value of 50. I am now losing $50. Okay, I'm losing $50. I received a $15 credit up front. So the total loss on this trade would be $35. Okay. Now, remember, if you also would have 100 shares. And let's just hypothetically say you bought 100 shares immediately and you bought 100 shares at $500. Well, what happens? If this goes up to 550, well, you're right up to 550, your shares are up 50. Your contract is down 50, right? So those cancel out. So this is what it means to be covered, is you own the shares and your shares are appreciating at the same rate that your call is losing. Okay. So covered calls. You only want to sell calls on shares that you own. And I'll add to that, as you're getting started here, like if you have 1,000 shares of Tesla, don't sell 10 contracts, right? Like don't sell contracts on your entire position. Sell if we're following the 80-20 rule, right? 80% hold, 20% trade. If we're following the 80-20 rule, you should only sell 2 contracts, right? Because 2 contracts controls 200 shares. That would be 20% of your position. So as you're getting started, just be very careful because what? If you lose, right? Like if you lose this and price does go up to our 550, remember our 2 people, right? Buyer and seller. You have to deliver those shares to the buyer, right? And so you're going to take your 100 shares and you're going to sell them, and you'll be forced to sell them at 500. All right. So let's take a look at a few examples here. Okay, so we're about to get into mean reversion. Now, James, feel free to jump in here as the math guy. But standard deviations. Okay, mean reversion measures standard deviations. And here's my silly example that I thought of, which I think is accurate. If you're at an airport and you're just people watching, how many 7-footers are you going to see? Not very many. 7-foot tall guys, right? you're not going to see very many, right? And so there is an average height for males and for females, right? And 95% of people are going to fall within 2 standard deviations of the mean. Okay, so if you see a 7-footer, that's a major outlier, right? There are not many 7-footers in the world. And so similarly, when we see price 2 standard deviations or higher, right? That is a anomaly typically. Now, caveat to that. If a basketball team walks off the plane, you might see more 7-footers, right? And so similarly, mean reversion, right? 2 standard deviation, you have to understand, like, did I just see 5 7-footers because there's a basketball team, or was that just crazy, or what? And so was there a major news catalyst, right? Did Tesla blow earnings out of the water and we're ripping face, right? So you have to be careful about, just because it's +2 doesn't mean it's for sure going to go down, right? So just be aware of that. But those are standard deviations. So when we look at the chart and we look at mean reversion, okay, mean reversion is the gold standard. It's our North Star for selling calls. Okay. Mean reversion is going to tell us when price is out of the ordinary, okay, significantly out of the ordinary, right? And so IADSS is what mean reversion comes from. And so let's go take a look at the charts here, okay? Now the way, so here's
another way I like to explain mean reversion is real simple, that everybody can relate to, is like a rubber band. So if you imagine the rubber band is, say, a ring this big, and you can stretch it to double the size. But how often do you do that? But if you imagine the normal size of the rubber band being that ring, if it doubles, that's an unusual situation. It means a lot of pressure is happening. And what happens after you release it, it mean reverts. So the easiest way to think about it is just the rubber band. And the more it stretches, the more it's going to snap back. That's it. And with all this stuff, like, there was another question that came up in the chat is, I still don't understand covered calls. I gave the Coachella example. If it's a big concert near Los Angeles every year, and people rent out their houses for 10 times what they'd normally get for it. If you get $250 for your house a night, regular off season, that's okay. But during Coachella, you can get $2,500. Think of those. You own the house, which is the stock. And then when there's a busy weekend, like a big spike, the rubber band, like the concert, that's when you rent out. You sell the call. You rent out your house. You get the money up front. And then everybody's gone a weekend later or a week later. And then the price mean reverts. You take your cash and you walk away. So this is a simple way to think about, in 2 crude ways, mean reversion and cover calls. Think of mean reversion being the rubber band and the cover calls being the house, renting it out.
Yeah.
Is that too crude?
No, I think that's great. And really, like, think about the confluence model is the same idea, right? Like, when these start to lower, here's your rubber band, right? Here's it's tight, and look at this major expansion. Your rubber band expands a ton, then it has to cool off, right? So it cools off, it goes sideways, sideways, sideways. Great covered call here, by the way, because we just go sideways. It's great. We get a dip, okay, and then we pop again. Okay, and so same thing back here, right? Narrow, narrow, narrow. The huge expansion. I know this was crazy, but
By the way, I look at all the charts almost every hour of every day, and we had exactly that. You can almost tell. You can see some of my posts about Bitcoin over the last week. The loose trend, all of a sudden, for the first time since 10/10, October 10th, Black Swan Day for crypto, it went blue. Another thing you saw on the Confluence model was it was contracting. And when you have the Confluence cloud contracting, it's only a matter of time before it breaks. It's either going to break to the upside or the downside. And that's where macro comes in to really analyze all of the different data points to tell you which way it's going to break. And I was very certain it's going to break to the upside. So there's the compression of the cloud. So these are little things that you have in your back wallet. And remember as well, the more data points you have that are mathematically backed with back tests, the higher the odds of you winning. It puts the gods on your side. And that's what we're going to get into right now.
Mm-hmm. Yeah. So if we were just to take a look at the back test, right? Like I think Tesla's such a good example, and we've had great examples recently of James selling covered calls. Okay. We'll take this as an example. Okay. Well, first, if you look at the back test, 100% win rate on the back test. If you look down here on the mean reversion, 71% on the mean reversion. Now, by the way, the mean reversion is even better, I would say, than the actual win percentage that is shown, because this win percentage, and James, correct me if I'm wrong, is accounting for every single signal here.
Yes, exactly. Yeah.
Yeah. So if you were to just, and not just eyeball, but you should go back and do your own hand tested back test. If we set our range, right, to +2, -2, if you just eyeball this, right, here, anything that's +2, this is like 100% win rate. Every single one of these, like, look at this. Every single one of these has been a good signal. It's been a great signal. Okay. So back test is even higher than, I would argue, than what is shown here. So make sure you're back testing, even if you're doing manual back testing and or practicing by yourself, right? Go into the replay tool, play it out. What would I do here? Sell a call. How would that go? And practice. Okay.
Yeah. You can also play with the ranges too. So if you want the big fat pitches, you can change your red and your green bands to your number of standard deviations. And you can say, you know what? I'm going to wait. I don't mind having 4 or 5 big trades a year because I know they're going to pay me a ton of money. And you can tweak those ranges down with standard deviations and wait for those exact big fat pitches in baseball, or if there's another, like, what was an easy layup shot in basketball or a touchdown in football. I'm really bad at sports, but those types of sports. But that's what you wait for. And then you just wait for those big special moments, and they're key. We've got Options Goddess here too. She knows exactly what I'm talking about as well. So,
yep. And so you can, the way that you can change this, and again, if you just wait for the +2s, and I would really highly recommend this for people that are just getting started. We're not here to trade every day. We're not here to, right? Yeah, we're not here to trade every day. We want to wait for the prime moments. Okay, what are the prime moments? When you look at Tesla, let's just eyeball this. Where are the major spikes? Right, like all this stuff in here, like we don't really care about, but this guy, right? All of these things up here have one thing in common, and they're all above 2 standard deviations. Okay, so if you can change your upper level here to 2. Okay, and similarly, you could go -2 for the buy signals. Okay, and now you filter out all this crap in the middle, all this noise, right? We don't care necessarily about all the stuff in the middle. We only want these major spikes, and then we sell. And by the way, on top of this, another great reason to be selling here as well is the premiums are much larger, right? Like if you look in this area, sure, it can be consistent. You know, if you're selling at the tops here, fairly boring. You're not going to get very super rich premiums. What happened here? We had we had a break of a key technical level right here, 365. We then had Elon buying $1 billion worth of stock, right? And then everyone's going crazy. Everybody's going crazy. Everyone wants to buy the stock. And so call options go up, right? So when you sell a call during these crazy times, you can also think about it as you're selling to the gamblers, right? You're selling to the people that think it's just going to go up to 1,000 from here, right? And if it doesn't, then you just get to keep the premium, okay? So rich premiums when we have these big mean reversion spikes as well. Okay, now here a few examples that I wanted to go through as well. If we come back to here, okay, big mean reversion spike, this comes down, and we end up taking a second leg here, okay? What do we do here? Well, I want to first say that you probably won, honestly, because if you are selling in this area, okay, we're going to sell out of the money. So likely a 20 to 30 delta is going to put you somewhere like at 380 or something like that. Okay. And by the way, from here to the move of the breakout, that's 24 days, right? If you sold 30 days, you're good. price went flat, it might not feel good because you want price just to tank, and then you want to see your call win. But this is still a winner, right? This is still a winner because 24 days passed, and you should close on weakness. Okay, so this is still a winner. Same thing over here. Like if we come over to recently, this here, let's say you were early. Okay, right? James is the best, so he sold he sold the very top here. But let's say you're not the best. That's okay, like me, right? Maybe you're selling anywhere in here. 440, you're going to sell out of the money. Maybe you sold a 470, 480, something like that. On this spike, sure, it'd be a little bit scary. You'd be losing. But then this ends up mean reverting and going completely sideways, right? And this goes sideways, what, for 3 months? And so because price did not go or expire, the price didn't expire above your strike, 480, that's a winner. That's a good winner, okay? So just keep that in mind. You just need price to not expire above your strike.
Yeah, there's one other thing as well that I learned a little bit later after the 90s when I was selling calls. Sometimes I get nervous if I didn't nail the top, and say I sell a $100 call and the price spikes to 110, but I'm covered up to 115. I used to get nervous and roll up. But now, because I trust the data so much, I don't get nervous. Even if Tesla spiked to 520, 524, I would not sweat it at all. And that's one of the things where people screw up, is they don't trust the model and they don't trust the data, and they panic buy back. Not a panic sell moment, but a panic buyback of the call that they've sold. Let the thesis, give it time to work out. You may not nail the top. There might be a bit of volatility for the next 24 or 48 hours, but chill, relax, let it come back down to earth, because that rubber band will always work. So there's a little inside baseball tip there. Trust the model. Don't trust your emotions.
Yeah, thank you. And we're going to have a good example of that coming up in a second. Okay, so let's go through some real examples here. So we have 3 examples that I pulled from Patreon. Tesla $500 call, and by the way, selling calls also is right. There's lots of different strategies and reasons why you might sell a call. Okay, so and here's 3 different examples of when selling calls worked out and was good. So we have Tesla just a few weeks ago, Galaxy back in September. And then A-Lab also just a couple of weeks ago, which today, yeah, anyways, this is a good chart. It's a good chart. Okay.
Yeah, we did Tesla twice in the last couple of months too, by the way.
Yeah, right. Yeah. So this most recent one, December 15th, James sold a Tesla $500 call. This is like the most vanilla, I would say the most vanilla, classic, standard, normal strategy that you can do. Okay. Sell 20 to 30 delta calls. We're on the 4-hour chart, and then we're going to sell 30 to 45 days. Okay, so you can see on the trade alert, let's big size this if we can, expiring in 39 days, sold the $500 calls. We'll call it $25 is what he got. Okay, and then you'll see the stock needs to rise another 10% for him to start losing. So 525 was his losing point. Okay, let's go to the charts. This is very, very classic, very basic. Is big spike here. I believe it was here. No, I think it was here. Oh, sorry. No, right here. December 15th. December 15th, big spike here. Mean reversion comes on. Sold the $500 call. Okay. A lot of resistance. Round numbers, we're going to have resistance. Everyone's eyeing 500. Likely we're not going to go through and blast through 500. And even if we did, likely going to mean revert. Okay. And obviously this has worked out and Tesla has turned over from here. Okay, so that's your classic basic example. If you look at just
by the way, those leaps or those calls I sold were trading for 180 on Friday, and I thought I could have bought them back, but I decided not to. Just because I'm so confident in the position. Are we going to break above 500 in the next couple of trading days? The answer is probably not. High degree of certainty. But that was also. Sometimes I do it to kind of showcase what I do. If I was an individual investor, okay, if you make 80% on a trade, Don't be me. I do it for fun. You take your money off the table. You sell something for $10, you buy it back for $2 every time. Don't wait. And then you wait for the next opportunity to sell again. Very important to look
And
at.
you can even, by the way, you can just set a limit order, right? Set a limit order, buy to close for $2 or whatever 80% is on your thing. And that way you don't even have to be looking at your chart, and it'll just go off when price hits that. Okay. So that's a great practice, closing once you are up 80%. All right. Now that being said, a few things about this call as well. The expiration date was January 23rd. Earnings is January 28th. Okay, so if we can't, well, yeah, not if we can't, we should. You don't want to sell past earnings, because earnings is always a toss up, and so we want to avoid that volatility, right? And let's just say that James did sell post earnings, right? Let's say maybe he sold in February over here, and we just go sideways here, and then something crazy happens in earnings, and we go like this. Okay. He went from winning, being up 80%, 90% to now losing because he decided to hold through earnings. Okay. So just, or like any other major events, like the We Robot event or like whatever, just be aware of major catalysts, major news, and you don't want to cross over, earnings being the main one. Okay. A few other great examples on Tesla. Just look at the mean reversion here. Great sell here, right? This one's a little bit early. That's okay. Right here, your mean reversion comes on at 350. We get one more push higher to 365, and then we roll over. Okay. So
yeah, by the way, the earnings note is very, very important. I don't give every reason for the times I choose, but it was very, very important for me for that strike expiration to be inside of the earnings date, because with Tesla, it's about 72% of the time after earnings, the stock will fall. I've analyzed every single earnings call. And even if the news is great, the stock sometimes still falls. If the news is incredible or the forward guidance is off the hook, the stock can pop. But remember, 72, 73% of the time, the stock will fall. Yeah. So, but it's also very dangerous because we're going into unknown territory where the world is changing very fast and Tesla is about to do crazy things over the next 2 years. So be very careful of what I call jumping in front of a freight train. This thing could pop to 650 if something happens. If they say, oh, we just deployed 3,000 cybercabs across Texas and California, boom, game over. Wall Street will have a freak out and they'll be buying bags like there's no tomorrow. And then you're on the wrong side of the trade. So be very careful. This is the dark side of covered calls, getting caught out. Okay. So make sure when you're selling a call, make sure you look out, say 45 days, and it's going to be a choppy, quiet period without anything that can rock the boat.
Mm-hmm. Okay. Great. Thank you. Yeah. And Elon and Trump were at dinner again recently. Like, you just never know, especially Tesla. You just never know. Government contract, whatever, who knows? Okay. That is Tesla. Let's go into A-Lab. Maybe we can get some commentary on here as well. This is more of a range rider. Okay, this was a range rider. So if we look at the chart here, pretty clear that A-Lab continues to range between our bands here. Okay, somewhere in here. So you can see up, down, up, down, up, down, up, down. And by the way, look at what happened today, right? Come up, and then we're, right back down into the range. Okay, so this is not your basic 4-hour strategy, right? This is not your +2 mean reversion, major spike, whatever. This is a little more calm. This is going to be when price is stuck in a range. And I believe James used the 15-minute chart for this, but you can see 63% win rate on the Confluence model. You can see good sell, good sell, good sell. Like all of these sells, good sell as we come out of the range and back down. 15-minute chart ends up being pretty good here as well. And I believe, if we look at the mean reversion here, see, and by the way, shorter time frames, you'll want to adjust your standard deviation levels, right? Like you're not really going to get a +2.
It was the 1 hour on A-Lab.
It was on the 1 hour. Okay.
Yeah. And it's just shooting fish in a barrel. You're not seeing a lot of signals firing. I see a lot more than you.
Is your noise suppression on 0?
Maybe. Anyway, not to worry.
Anyways, yeah, I've noticed that, but anyways,
my trading style is always aggressive too, so you had it on neutral.
So, anyways, Range Rider coming into resistance. Resistance usually continues to be resistance here, and if it didn't work out, right, he was covered until 198. Okay, where's the gap fill on the chart, or where's the resistance likely going to be? And the next one is right at 200, right at 198. Right, so this is a low risk. This is very likely going to work out unless something crazy happens, which usually it doesn't. Okay. Last example here is Galaxy, back from September 11th.
Wow,
Opened up the three-legged.
Didn't realize it was 9/11.
Yep. So opened up the third leg of the stool. Sold in January. So maybe talk us through this one a little more. And I'll bring up the chart to refresh your memory. This one's a little bit further out. This was 90 days out. Okay, so this was September, sold January of 2026. Sold Galaxy for 550, huge premiums. Stock was 29. So he's covered down to 18. So let's look at the chart. This is an interesting chart because if we look, I drew my arrow here. Big move to the upside. There's your mean reversion spike. Okay, so everything's going to plan. This is what we're doing for. You'll notice though, by the way, he said, I hope to get called out if it keeps going. So he's okay, right? If we kept going, it doesn't matter. That's what we wanted. We wanted to sell this position anyways. And I would recommend that for some people too. Use covered calls as a way to exit your position, right? Because a lot of us have a hard time selling. Sell a covered call, maybe sell it at the money, and just plan to get called out. Okay. So maybe talk us through a little bit about this. What were you thinking as this kept going up?
Yeah, nothing at all. Again, don't sweat it because the goal was to get called out, but that's just what happened. But I do want to say something as well. Is not only you can let the market help you exit a position, aka profit take, but also the opposite of doing that is you can build a bag by selling puts. Even if you sell a put too, you may not get put the stock if the stock doesn't fall, but if it does, you do, and you get it cheap. So I want people really to wrap their heads around selling puts, selling calls, selling puts, selling calls. There's a huge amount of money to be made in that. Buying and holding, it works for asymmetric assets, but there are things behind the scenes that, like for example, Galaxy. I personally think Mike Novogratz is a bit of an idiot. So I don't want to, so I'm very focused on the leadership of companies. I got into that position because they had a very good crypto basket, but above $30, $35, it wasn't that attractive for me. And it's $26.50 now. So I don't know, but also you have to bear in mind, again, taking into a timeline, I thought there would be the end of a bull market as well by then, which didn't happen because we never had one in the first place. So that's why it's important. Yeah. Also, this question here from Coin Operated: selling puts is the same as selling calls. It's just at the different end of the mean reversion. Can you show that on the chart for some other asset?
Yeah, we can show this even on Galaxy. Now, selling puts, I would say,
like Broadcom today is a great example.
What's a great example? Sorry,
Broadcom, AVGO.
Oh, okay.
What I did this morning is a classic example of the opposite of selling calls. I sell calls on price spikes. I sell puts on price dips. And I've wanted to get a piece of Broadcom because I analyze AI a lot, and their TPU business is huge. And that's why I need some exposure. I have NVIDIA, but I wanted some hedge for my NVIDIA, and that is my Broadcom. So even though it's not rock bottom, I'll go in twice the size, 3 times the size of the allocation. Today was double-digit leaps in terms of number of contracts. If it does dip to 300, that's my next layer, and my next layer after that is about 271. So, sorry, there's a dog here in my lap. Hello, dog. Say hi. People wondering. So that's kind of the exact same thing. Coin Operated, selling puts, same as selling calls, but just use the mean reversion to do that.
Yeah, and
you have to go in a much shorter time frame too to see the Broadcom, like 3 minutes, 5 minutes. We'll get it to you.
Yeah, short time frame on this one. Yes. So and this is a good example too, because right, James, maybe talk us through about this as well. You picked January 2027, only a year, and normally Tesla, things like that, you picked 2 years or more. Why just a year?
The pricing for the puts was really generous. I looked at a year, and I looked at another 2 years. It didn't matter. I know what's going to happen in 2026 will be where I want to be, but I also want to get allocated Broadcom in January 2027, and I try to minimize my cash outlay all the time. So I do this for sport, but it's also a lot of fun. It's for me, it's an intellectual challenge to trade the markets. I entered a position today where, as long as the price stays above, I think, was it
346.
myself, I got a lot of numbers in my head. Here we go. As long as the price stays above 336, I make money. The price is 342 right now. Okay, because the pricing on, and I know, Jacob, when you looked at it later, it had already gone up $6.
Mm-hmm.
And also, when you have a stock that tanks $15 in minutes at the open, it just tanked. To zoom into like the 1 minute or the 2 minute chart, you'll see that huge tankage. All of a sudden, the market makers that price the options and the volatility of the stock spikes up the put price. Everybody's panicking. Everybody's buying insurance. Imagine you're in Florida and there's a hurricane coming your way and you're uninsured. What are you going to do? You're going to call your insurance agent. I need to buy insurance. It's the exact same thing that happens with stocks. Big spike. I don't know. Can you go into the 1 minute or something?
Yep.
You'll see it. Or the 5 minute, you see that huge spike.
Let's see right here
at the open. That's big spike.
This is your opening.
This is the hurricane coming to town. This is people scrambling to buy insurance and freaking the hell out. This is when I sell the put. And then I look at the call options and try find the right balance. So no matter what happens, I can make a profit, even if the stock stays at where I sold it at, 326, 327 for the next year. I'm not losing any money. That's what I tried to do. And minimal cash outlay as well, to have exposure to this asset that I was looking for.
Yeah, and reminder for everyone here too. There's a difference to he sold puts as part of buying a call, like by doing a synthetic long. You can, so that's longer time frame, right? And that selling the put really helps pay for that call. So that's why the break even is so low. Okay. You can also sell puts similar to covered calls for 30 to 45 days. Same idea, right? Is like if we were to go back to the Tesla chart, like when was the last opportunity to sell puts? And it was perfect. It was right here. Okay, right here, it's just the exact opposite, -2. Okay, and quick lesson right on puts here. Buying a put means you can sell. Let me get my pencil out with my people. Okay, here's my people. What is buying a put? You got a buyer and a seller. And let's say you have a $100 put. Okay. What is buying a put? Buying a put is insurance. And so if you buy a call, that means you can buy shares. If you buy a put, that means you can sell shares. Okay. So if you buy a put and price goes, let's say you bought a $100 put and price goes down to 70. Well, great. You protected yourself because you can still sell your shares at 100. Okay, great. Sell your shares to who? Sell your shares to this guy, the seller, right? So when you're the seller, the car insurance, I think, analogy is better here than it is for calls. Because when you buy car insurance, you pay the premium and they insure your car in case of disaster, right? And then a disaster hits and then you can cash in on your premium or on your insurance policy, okay? Same thing here is if price crashes, well, you are the insurance company, so you have to cover the difference, right? So when you sell puts, when do we want to sell? Well, we want to sell during peak panic, like James mentioned. Peak panic, when the hurricane's coming, insurance is really, really expensive. Okay, so when we get down here, everyone's freaking out. Everyone thinks we're going to go lower. Mean reversion prints the perfect dot at the bottom. Okay, and same thing, you can sell a little bit out of the money, 20, 30 delta out of the money. and this ends up turning back up and you win. Okay, so it's the same idea. So if you wanted to do this, sell puts here, sell calls here, sell call, sell call, sell put. Okay. So two different ways to sell puts. Either go the long term for the synthetic longs like James, or the 30 to 45 days with the same idea here. Okay. Right. So that's selling puts. Just going to wrap up our slides here, and then we can just take questions from the chat if we want to keep rolling. So a few reminders here on our position management. Okay. Avoid your major catalysts. I know I mentioned this before, right? Avoid selling past earnings, right? Make sure you go look on the calendar. TradingView is really good for this. Just look at the little E down here at the bottom. This is where earnings is every time there's an E. Okay, so the next one coming up is January 28th for Tesla. Okay, so just go look for your E's. So avoid your major catalysts like that. Or like if we have a major announcement and then we keep spiking, like you just have to be aware, like, is this asset really going to keep going? Because this time is different. Is this time actually different? It's hard to decide. Take profits early. Okay, take profits early. Like James said, 80%. So we want to avoid round tripping, right? Where we were winning and then we were losing. Okay, so you set your limit order. If you sold it for 10, buy it back for 2. Okay. And then the last thing that we didn't really talk about, but we'll just touch on real quick, is rolling. Like James said, if you trust the tools, then he doesn't really roll anymore, because usually we do come down. Now, if you really have to roll or you want to roll, you need to get enough credit to cover the loss, right? So how do you do that? Well, the way that you do that is you sell more time. Okay, you sell more time, and rolling is just fancy term for closing your position and opening a new one. That's it. Closing a position, opening a new one. So if you need to, you can roll further in time, although these tools are quite good. And on that note too, also only sell on things you are willing to get called away on. Okay. So just be very careful when you're doing that. All right. So that's it for the slides. Key takeaways here. Mean reversion is great. Okay. You can use your existing bag. You can use your house to generate rent. You can use your shares to generate return. Okay. What can we then do with the return? Fine. If you have to use it for day-to-day expenses, whatever. But if not, right, what can we do? We can take that, like, let's go back to the chart. If you would have sold calls up here, okay, up here at 500, or actually back here, let's say we sold back here in September, right? On this mean reversion dip, you just take all your premium and you go buy more shares, right? This is a great way to continue to grow your bag. Okay. It is a slight hedge, right? If you're neutral to slightly bearish, it's good too. And every time you sell premium, you're effectively lowering your cost basis on your shares just by over time collecting more and more and more premium. Okay. So that's it for the slides. We're happy to take questions from the chat. But what delta do you like to sell? James, I'll leave that one to you. 20 to 30 delta is usually what we sell. But I know sometimes, James, I've noticed you sell 45.
It depends. Literally, I will scan an option sheet like you showed earlier, and I will find the optimal juiciest price. I don't even need to look at Greeks because I can calculate it all in my head because I've been doing it for 35 years. So yeah, the higher the better. The higher the spike, the better. The juicier the premium. Don't get too bogged down in the Greeks because every asset has different volatility. Like, for example, if you look at mean reversion on the S&P 500 versus Tesla, I mean, you can only play tiny movements in the S&P 500 because it's so stagnant compared to something like Tesla. So this is probably, if you go in a lower time frame, you'll see what I'm talking about. But it doesn't move a whole heck of a lot, you see. It doesn't. It never goes outside those bands, unless, of course, you get a black swan. So again, the point is every asset is different. And once you know how the Black-Scholes model works, you know how the market makers price things, and you can see I like to focus heavily on pricing anomalies. For example, this morning, the puts were so expensive, and I could get a big position of an in-the-money call by selling time. So yeah, I look at this and I'll be able to tell you in a second which are the best ones to buy and sell because I've been doing it for so long.
Yeah. So yeah, good answer. I would say if you're just getting started, like be conservative. You can sell a 10 delta. That's like way conservative if you sell 10 delta. And as you get more experience and you start to understand how the pricing works, you can slowly inch your way closer. Now remember, like the $500 call that James sold sounds aggressive at the time, but you have to remember that he's the closer to at the money that you're selling or in the money, the larger your premium is going to be. So that also gives you more wiggle room, right? Like if you sell a 500, we immediately think like, oh, I mean, price went to like 498 or whatever. Like, oh, like James is in trouble. But remember, he got $25. So he's good all the way up to 525, not just 500. Okay. And so, like, let's say we get close to 515, by the way, this is really important. If we get to 515, all right, you cannot, you can't let that option expire, because then you'll be exercised and you will sell your shares and you'll have this like taxable event, blah, blah, blah. So you have to close your position. Okay. You have to close your position. So when we get close a day or two before, close your position. Because again, if he's good up till 525, we get to 515, he still won $10. But because that contract is now intrinsic, $15 intrinsic, that will be exercised if you don't take any action. So just keep that in mind. Most brokerages, unless you like tell them specifically, most brokerages automatically exercise any options that are in the money. Okay, so just keep that in mind.
Yeah, and one other thing as well that people forget. So if you imagine you sell time, I sell things out of the money. Imagine we could talk about that 515 example. As the stock goes to 515 and you look at the call option you sold, and there's only like 10 trading days left, what happens is the time value goes away and it all becomes intrinsic value. So the more it goes in the money, the more time value goes away. So that's another mattress cushion you have for selling these things. And it's very, very important to wrap your head around that.
Yes. Do you sell calls as soon as the mean reversion dot prints or wait for the sell signal on the confluence model chart?
So the charts I look at and the things I trade, like because I obsess. Obviously, I'm 56%, 58% Tesla now. That was my big gambit to rotate and build an AI position, and I was able to do that thanks to MicroStrategy. But now I think it was a guy called Steven Druckenmiller. He said, have very few assets in your basket and watch your basket very carefully. I watch my basket like a hawk. There isn't an hour that goes by that I can't tell you exactly what Tesla's doing, even in after hours. So when you watch something so obsessively, you understand how it moves. I used to talk about how charts and assets actually move like animals. They have their own DNA, their own personality, and you can almost predict what it's going to do, even without, these technical analysis tools and back tests. So from that perspective, I can anticipate if I see a big mean reversion spike, that's the first thing. It's like, okay, now I know my premium is going to be juicy. Then I look at the trend model across different time frames, like the daily, like the 4 hour, like the 1 hour, the 15 minute, the 5 minute, and get a feel for when it's going to turn. And then I look at the confluence model. I'll be able to anticipate when it's about to flash a signal to sell. Because I know the model so well, I know the assets so well. So I actually front run the signals, sometimes by a few minutes or an hour or so, because I know what the asset is going to do next. You can see it as clear as day, every single day. So,
yeah, good question. Yeah, I mean, I would say mean reversion. For the basic answer, I think, is mean reversion is the dot. Like, yes, ideally we get other signals as well. Like, over here we had a sell and the mean reversion dot. But if you were to go off the mean reversion only, I think that is a good place to start. And then, but yes, ideally you are looking at different time frames and looking at all the different models to look for when the turn is going to happen.
Very important point here for Hobbit as well. Great question. Selling calls is nothing to do with confluence model. Your Bible is mean reversion. Everybody get that clear. Mean reversion is your indicator to take money off. The rubber band stretching, big stretch. Think about exiting. The only caveat to that is if you think the asset is going to go on a rampage and continue to going up, then you look at your optimized trend line across shorter time frames. And there are times where I'm very, very conservative, and I could have sold a ton of calls, but I don't, because the optimized trend keeps me in the trade. That is so important. The blue thing you see there will keep you in the trade. The orange thing will keep you out of the trade. Wait for that to turn and zoom into closer time frames. That is super. So you get your signal to maybe sell a covered call on your mean reversion, but it doesn't mean it's not going to stop going up. So watch the optimized trend.
Mm-hmm. Yep.
Like there's a good example right there. You're looking at whatever that dot
right
is. Like you see the trend is going blue all the way up and you have a mean reversion sell.
Mm-hmm.
And then the second one is what you wait for. And then you hang tight until you start seeing the trend chart getting thin. The girth disappears. That's when you know it's about to turn. The other thing is a simple little trick. And these things, the best things in life are simple things, everybody. Look at these lines. We're looking at a time frame here. I can't see the bottom of your chart because Hobbit's covering it. Can you hide the current comment? Yeah. So if you look at this time frame, you have months and months where it goes up blue, and then it goes down orange for a month, then it goes up blue for 5 weeks. Think of that time frame. When you see it getting thin, you know it's about to turn. So also just front run that amount. And again, if we're already on a downturn too, as well, very important to remember, the options premium will suck because the spike has gone out of it. And this is the magic of the science, is being able to anticipate that spike, know the options pricing is high after a big move up, sell. Even if it continues, but it continues at a slower rate of change, the option price will dissipate. So you won't actually lose money. So for example, talking Tesla again, imagine it's 475 after a huge spike from 450. And then you sell a call for 500 at 475, even if it goes up $20 more, but if it goes up gradually, the options pricing will be the same. The options pricing is a function of the violence of the move. You trade the violence of the move and make sure you're on the right side of the trade and keep an eye on the trend. So this is like everything you need to know about making money is everything I said in the last 60 seconds. It's not hard. And Options Goddess, we should have her on too and join her for next one. Drop a comment if she's listening to that, because don't overthink it, guys and gals.
Yeah, and like so. Easy rule 2: you got to sell on a green day, or you want to sell when it's green, right? Like the difference between selling on this day and 2 days later, once this goes down, is major, right? When you have this major spike versus selling down here, it's too late. I don't know if it's too late. You're not going to get as much. That's for sure. So, all right.
I don't do ratio call spreads, by the way. One thing I do recommend, I always say, find your rhythm. If you find something you have success with and you like doing, whether it's the wheel or ratio call spreads or collars, do it. I wait for the big fat moments. That's my thing. And I sell a put to buy a call, or I sell a call on the spike. That's pretty much all I do. But I do it again and again and again and again for decades. Real simple.
Yeah, good question from Bear. Regular trading hours or extended? And
I always use extended. Yeah.
Extended. Okay. What's your opinion on if you're doing
by the way, one of the things that I want to say as well, it's kind of peculiar, but if you look at what happens to a stock during any given day, okay, they tend to open strong. During the midday, you get the slump, and then they close strong. So always anticipate that V. If you're going to sell something, do it either at the beginning of the morning or at the end of the day, trading day. And also, a lot of the real action for price happens after the market close. That's when the big news is released. So if you look at, say, I always talk about the 10 trading days a year where it really matters to be in a trade. That's so important because that action happens typically after hours and you get a spike at the open the next day. If you're not in the position before the spike, you're stuffed. Very, very important to know. Okay, so understand the rhythm of the day. Absolutely critical. Same thing with the rhythm of the week. Monday and Friday, all the action. Midweek, dead.
Great nuggets there. On the Tesla January 2027 leaps, would you cash out at 80% profit or wait till expiration and buy the shares?
My entire focus since 2017 has been to build a big Tesla bag. And I've converted every single one of my leaps. And I have hundreds and hundreds and hundreds of leaps. I've never had so many high price leaps in my life for an asset. And I'll be converting them all. That's why I've got such a huge margin bag. I never use 10% of my margin because I've got a massive, massive numbers of leaps I need to convert in January. And then same thing in summer, and then same thing in December and January 2027. So I'm always keeping an eye to build that bag. And remember, my goals are not your goals. I'm about growing stuff slowly. I know where Tesla's going. I just need to be patient and accumulate as much as I can. That's my whole mission. And I advise everybody to do that. Get to 300 shares, then get to 500 shares, then get to 1,000 shares. That would be very life-changing. So all of my leaps, I convert. But if you're a trader and you made 80, you tripled, quadrupled, quintupled your money, you want to take some profit and take a flyer on crypto, go ahead and do that. But that's not my goal.
Yeah. And on that note too, leaps are like they're different than calls than selling. Like if you bought a call versus selling, they're very, very different. And so you said that should I cash out at 80% profit? Your leaps probably, depending on what your strike is, can be up far more than 80%, 200, 300, 400, 500%. So a little bit different there. The rules are not quite the same when you buy. And two, another great thing about leaps is when you go to exercise, it's a great tax advantage, right? If you sell your option, your contract back, you have to pay capital gains. If you exercise your option and just buy the shares, there's no that's not a taxable event. Right, so just keep that in mind as well.
Yeah. The other thing people ask, how can I calculate things in my head? It's very simple. Just look at the money straddle price of the options pricing. Look at the time, look at the probability, and look how far the stock can realistically move. And that's it. How likely is the strike going to hit? And that's all you need to do. And that's how you can do it easily. It's not hard, but it does take time. And I used to have to do this for a living, by the way. So, but
do you
with
find
like currencies and commodities?
Do you find that delta is a accurate proxy, right? Because people say delta is a good proxy for the probability that this stock is going to expire or this option is going to expire in the money. So 20 delta, it's only 20% chance you're going to lose. Do you find that to be accurate or not?
No, because when people say that, it's like saying, well, TA says this. I always say FA is for what and TA is for when. FA is fundamental analysis and TA is technical analysis. Technical analysis is your timing. Fundamental analysis is keeping your head out the window, looking at the macro, understanding where the stock goes on a seasonal basis, etc. You cannot just look at deltas. You have to look at everything. And that's why I laugh when people are just TA only traders or FA only traders. You need to be extremely well-rounded. You need to have that tool belt with all the different things in your bag and be able to recognize seasons and patterns and know when earnings are going to hit and know what that earnings is going to look like and all that type of stuff. Absolutely critical.
Great. I feel the same. I never felt like delta is a great is a great proxy for expiring in the money or not. But a lot of people ask that. So
yeah, and there's a good question here, extended trading hours. So I think Robinhood, they're gunning for what they call 24/5. So 24-hour trading 5 days a week. But that won't apply to options, of course. So it doesn't really impact me. But everything, again, once everything goes to 24-hour trading, the whole news cycle for stocks will change. Assets like, whoever company it is, they always wait till after the market closes to announce big news or announce earnings or whatever. Once we go 24/7, 24/5, the whole news cycle will change. People will just release news as it happens. And we're going to move to a real-time world where you need to be ready 24/7. And that's going to bring about a lot of sleepless nights, my friends. But hey, that's okay.
Yeah, I was wondering about that. Do you think when 24/7 or 24/5 trading comes, which it sounds like it's going to, do you think volume overnight is going to be lower and it's still kind of dead and people still do the regular cycle or no, it's all the time whenever?
Well, the big money and the hedge funds and Wall Street, they all use algos anyway. So the algos will be doing 70, 80% of the trades. There'll be the schleps who turn up to their 9 to 5 and go to the job or the market and trade there. That will be the big chunk of the volume. But I think we're going to move much more towards tokenization and algo stuff. And that's how the whole convergence between crypto and AI and TradFi are all happening. And it's just going to be wild. And that's why I always stress as well, this is kind of like the next 2 years is our window of opportunity. After that, the machines take over. That's it. You'll be able to do swing trades. You might be able to do covered calls over medium terms, and you'll be able to get positioned in assets early. But all the short-term trading opportunity is going to go away. Gone. Done.
Nice.
Or not nice.
Be an interesting time.
Stealing money from a baby won't be as easy as it has been for the last 2 decades. Put it that way.
Now we got to steal candy from teenagers.
Or, as I said, zero-sum game. I mean, if you have an idiot on the other side of the trade that doesn't have the tools we have, you're going to smoke them.
There's still going to be opportunities.
Oh, yeah.
But, yeah, scalping and whatever. It's already hard. If anyone's tried scalping, it's very hard. I'm not a good scalper. So, cool. All right. How do I know if puts
I do have to wrap in about 1 minute or so. So,
okay.
Well, last question I'll take. How do I know if the puts or calls are expensive or cheap? Again, I'll go back to what I mentioned before, how you can eyeball it. If you think of the position as first of all, first question you ask yourself, how far do you think the stock can move, either up or down? Are you at a support level or a resistance level? Look at the at-the-money straddle price, and that's the market's estimate of the move by the expiration date. You look at the time. How much are you getting paid for your time if you're selling a call? More time, the options will be more expensive, and therefore the optimal window is kind of 4 to 6 weeks. And if you think of that in trading days, it's about 30, 35 trading days. Okay. And the last 30 days, absolutely rapid time decay. Like if you imagine I sell $250,000 worth of covered calls on Tesla, I know I'm making 30 grand a day at least in time decay. And that's enough to pay for my mortgages for 3 years, So, or something along the lines of that effect. But that's the way you think about it. And also, how likely is the strike to be hit? You look at your mean reversion, your chart, your historical patterns. How many standard deviations does it actually need to move beyond where it is today to be hit? That's your edge, everybody. Don't overthink it.
Practice. We've got lots of great coaches and tons of videos that both James and I have made. So lots of resources, and I think today's been great. I think lots of great nuggets today. Got to practice.
Yeah, and take the time. Don't be intimidated. People sometimes have a hard time wrapping their heads around options. As I stress, understand margin, respect it, understand options, get started with covered calls. Don't overthink it. Think about renting your house out at a very special weekend or week or summertime period at a high premium. and then let the time expire. Get familiar with your TA and have your head out the window and understand how stocks and assets move. And don't do what Lynn Alden does. She's got 65 positions in her recommended portfolio. That's complete idiocracy. Okay. Literally, I never like to have, say, 90% of my portfolio, 85% in just 4 things, because I look at the markets 24/7. I can't be deep in more than 4 things. Okay. Think about that. If you have a full-time job and kids and wives and husbands, you can barely look at one asset. So remember that, everybody. Very important. This is probably the most nugget-filled session we've ever had, Jacob.
Yeah, that was a great.
But literally, people should watch this, write this stuff down. This is a lifestyle, a lifetime of experience and scars that we're sharing here. Okay, learn this so you don't have to make the same mistakes that I did over the last 35 years. And practice, paper trade all the time. Okay. Then when you get confident, when you're winning 70 to 80% of the time, watch the back tests. Then you're confident enough to unleash and start printing money in your own personal money printer. That's it. Easy peasy. And if I can do it, anybody can do it. All right.
All right. Thank you. That was great.
Great score. Great class. And thank you, Options Goddess, for being here too. Options Goddess actually trains people, advanced options, and she is brilliant. So
we'll have her on next month. How about that?
Let's do February. That. Yeah, let's take this to the next level around what we can do. Maybe do more around kind of the barbell of the put selling with the call selling and range riders, and identifying those, because that's also an extremely good thing to do, to build a bag selling your puts. Like every time I sell a put, I do a synthetic long, I'm technically building a bag. So I sell the put because I do not want to pay the ridiculous cost of the leap for Tesla. It's just way too expensive. And another simple little rule for people to know, and I see this happen all the time, people spend far too much on leaps. Leaps are not a silver bullet unless you have an asymmetric asset. But when I see people spending $150 on a $250 stock on a leap, that's ridiculous. Don't ever do that. Never spend more. I have all these little rules and limits in place, more than a third of the asset price. So if it's a $300 stock, never spend more than $100 on a leap, ever, ever, ever. And that's why I love selling puts. If you can nail the bottom or get very close to a bottom and get all that spike revenue from the dip to fund your leap call, you make a fortune. Okay? Real simple.
Great. So many things. I'm going to go back. I got to go back and watch this now too.
Right. Maybe we'll put together a cheat sheet of some of the big things.
Yeah, we should put, I can put something together.
And if it's okay, we'll share your deck in PDF form later as well, Jacob, with the community. Is that okay?
Sounds great.
All right. Thanks all.
Okay. Thanks, everyone. Thanks, James.
Bye.
Good week, guys.